Don't place a trade based on what you'll see in this video because there is no guarantees of making a profit in the market. It takes you a long time to become a good trader. So this video here is just to educate you to become a much better trader. Hey traders, John Howell here, and in today's video, I want to be covering two different things. One, obviously what's going on right now in a short term, probably over the next maybe week, maybe next to a month. And obviously why I believe that we will see a second phase of this crisis that I believe that's already started underneath us. And I'm going to unwind why I believe that from a technical point of view and also from a fundamental point of view, because there's a lot that we can actually see. Okay, so firstly, I'm going to talk about what's going on right now and what we can probably see short term over the next maybe few weeks to a month or two, maybe more. But then why long term? Why over the next probably couple of years, maybe even sooner, we're likely to see, or we're likely to get, are likely to get a second phase coming down. And that second phase can probably even be more deadlier than this whole virus situation that's happened in America, and around the world, right? So this virus situation that we've seen, it's been deadly health-wise and also financial-wise. But I believe the second wave of crisis that's coming is going to be even more deadly. And I'll talk about that as well too. So let's focus on the short term here and I'll get to the long term stuff. The short term, what's going on right now? Right now we can see the SP500 is still trending up very, very, very nicely. We're not turning around yet. We're not getting any downward movement yet. If I zoom in on my charts really, really closely, in fact, let me just I'll bring up the candlestick charts here for a minute for you guys. Actually, you know what? Let me go to this chart here. It's much easier for me to see personally. So you can see how we have a rally up, sideways, pull back. We have this sideways here, and then we have a break up, right? And then we've now continued up from here as well too. Let me see if I can do this here, right? Let's go back here. I'm just switching between because I'm trying to make sure that you guys can see it much more clearer as well too. But anyway, so we can see we've had a nice rise. We've made a higher low, and now we're still continue to rise through here. So on a short-term basis, I actually do see probably S&P is probably likely to run up to around about, I would say, around that 3,000 that 3,000 there is the target for me on the S&P 500, but we're still rising up. So on a short-term basis, there is no sign of this selling move starting to happen right now. So on a short-term basis, guys, I definitely see this thing continue to rise and probably rise for the next few months or more, really, overall. Again, maybe next month or two, who knows, but that's on the short-term basis there. Also, looking at the Dow Jones Industrial Average, we're seeing on the Dow Jones Industrial Average, we had a low, rallied up, we made a higher low, and look, we're just slowly crawling up right now. Crawling up. So on a short-term basis, the Dow Jones is likely to get to around the 25,000 mark. But my ultimate target for the Dow Jones, I believe we're likely to get to around the 27,000, maybe over the next couple of months from there as this rises up, okay? So we can see it through there. If you look on my charts, you can see how we've got this major support level through here. So that's where we're probably likely to run to since we're now breaking above this. So 25,000 would be a short-term target. And then the next target above that would be, my ultimate target would be 27,000. We've also got a gap up here as well too to be filled. So we're probably likely to see that gap being filled as well. So on a short-term basis, guys, we all know the trend is your friend, right? Until it's not. So right now the trend is continued up. So the short term is continue to be very bullish for these markets. And obviously look at the Nasdaq, right? The Nasdaq is steaming ahead. It's just the Nasdaq actually has a gap up here around that 9,400 to 9,600 level. You can see how it actually had this gap up here. If I zoom in on a bit more on this chart, you'll be able to see this major gap through here that we've had from here. Let me just bring this down so you can see from there to there. This is one major gap. So if I squeeze my charts back up again, you can see how Nasdaq is pretty close to actually coming and filling that gap and probably even racing up to all-time new highs. The tech stocks are absolutely just booming right now when it comes to Netflix, when it comes to Amazon, Apple's starting to make some nice moves as well too. So we're really starting to see some really, really nice moves, and I wouldn't be too surprised to see Apple come up and close that gap as well too. So we're getting a lot of bullishness signs around here on the S&P 500, the Dow, and so on and so forth. Okay, so that's the short-term basis, guys. Over the next month or two, or maybe even longer, we're probably likely to see some more rising. But let's talk about what's probably likely to happen over the next year or two, and why I believe there's another second major wave of crisis, and why the stock market will roll over again. And this time it's probably going to be even more deadlier, because what's happened here is this. If we're looking at this from, that's that big picture there. If we're looking at this whole chart, let me bring up, say, the weekly chart here for a minute. And let me bring up, say, the S&P 500. Right, and we bring this up here. We can see we've had this big, massive flash down. Okay, this big, massive flash down, and now we're getting a very strong movement to the upside. And that's obviously because, you know, the Fed has stepped in. Okay, so we had this big flash here. The Fed dropped interest rates a little bit, and then they slammed it down to zero. And then the Fed came in and started printing a lot of money and just putting absolutely just a bazooka into these markets, right? The Fed came in and gave the market a floor, and they put in so much money into these markets, and that's one of the reasons why the market is continuing to rally. Now the market did need some form of a pullback anyway, because the market never, as you can see on these charts, right? No matter what happens in history, the market never just goes straight down like that. So the sharper it goes down, the harder it's going to snap back. So that's on the S&P 500. You can see the same sort of thing on the Dow Jones through here. And once again, I do see the Dow Jones get up around that 27,000 mark. But we can see we've had a big move down, all right? And once again, the Fed has come in and stepped in to find a bit of a floor on a short-term basis, okay? Again, that may last a few months. They may last 6 months. I don't know. But we can see that that's what's happened. They've slammed interest rates down. They've printed a lot of money. They're going to keep printing a lot of money with 0% interest rates. And we already know that the debt that the government has been building up lately has been just out of control, right? And we all know that there's a debt bubble brewing behind the scenes. And so with the debt bubble brewing behind the scenes, we know that that's becoming an accumulative effect, right? Right now with interest rates at zero and then printing a lot of money, they can service the debt no problems, right? They're servicing it, and then they can monetize it, and everything's going well through there. Okay, but what happens? What happens if they have to? What happens when they're forced? What happens when they're forced to maybe start to raise interest rates again? Maybe inflation picks up, but the stock market's not going, or maybe the market itself forces interest rates, you know, but via the bond market correlation between the interest rates, you know. Maybe we start to see the public in correlation to the bond market, we're going to see interest rates rise. And what I mean by that is obviously interest rates go up, based on the bond prices as well too. So that's why I say, guys, that yes, short term, and guys, I'm long right now. Okay, I am long right now. I'm long a lot of stocks. I'm long the SPY. I'm long bank stocks. One of the bank stocks. I'm long, some of the tech stocks as well too. So I'm in this long right now. But I also do know that probably over the next month or two, I'll be out of this thing, all long positions, long term, because I do believe, yes, we have started the next leg down. And that's why I've said in the title, why we will see, why the stock market will, roll over again very soon. Is because of that. And that's what you want to wait out for. Right now, the markets continue to rise, and it will continue to rise probably for the next few months until this whole pandemic situation starts to unfold and become good again. But you watch the interest rates. When they start to raise, when the interest rates start to rise, whether the Fed does it or the free market forces the interest rates to start to rise, that is when this whole thing is going to completely collapse, and we're going to see even probably a worse move on the downside. This is massive debt build up. But for now, guys, no, nothing's happening with the free market. Interest rates are low. They printed a lot of money. They found a floor in the market. That's the reason why the market's been rising so much, and we're getting a rise, and we're going to continue to rise. Okay, and hang on. And the thing is, guys, is that this rise that we're getting right now may even last into the end of this year. We don't know. Okay. But if you're looking from a macro point of view, guys, and this is not like one day sort of thing. It's not like they raise the interest rates once and then suddenly the market collapses. It's not like that. It's a cumulative effect. So if you start to see the Fed maybe having to raise interest rates again over the next, say, 6 months or so, or the free market forces the interest rates via the bond market, start to see the interest rates rise, that is going to put so much pressure on the debt that's been built up, and that's when we're probably going to start to see. We're already starting to see a lot of money and a lot of debt restructuring, a lot of debt default from the government itself, healthcare, pensions, and all that sort of stuff. It's going to be really, really, really bad when that happens. Again, we may be another 12 months from that happening, but the sign to see that we're likely to start to see some weakness in the overall equity market is when they have to start to raise interest rates, or again, the free market forces the interest rates to rise. On a short-term basis, guys, we're likely to continue up, so don't fight that. But once again, guys, the free market and what's likely to happen, once we get that, guys, that's when everything starts to unravel, and we're probably likely to see, at least a couple of year of a slow trending down, or at least another bear market. I don't think we're likely to see another crash like this on the Dow Jones, like here. I don't think we're likely to see this here. This here was frightened because of everything that was happening, right? So I don't think we're likely to see something like that again. But I do believe we're likely to see, maybe a stair-stepping phase like we did in 2008. So that's the reason why, guys, that down we go again, and why I do see this happening. Hey traders, I'm running a flash sale. It's a $7 flash sale to my brand new Grab the Markets by the Balls trading course. If you go to johnsflashsale.com, you can get access to the $7 massive sale that I'm doing right now for a short time. So go to johnsflashsale.com and I'll see you over there.